Hi, I'm Brock.
I'm Jim.
Before we get started, if you want to stay ahead of the cattle markets, sign up for our free daily briefing at herdadvisor.com. It's delivered right to your inbox every morning, 5-minute read. And if you've ever wished you could keep complete cattle records without the clipboard, the Cattle Record Guide lets you enter records from the field with your gloves on. Just say, "Hey Siri, try it free for 14 days at herdadvisor.com. Well, welcome back to Cattle Market, guys. I'm Brock, sitting here with Jim on this Friday wrap-up for July 3rd. And folks, there's a lot to get into today. Let's start with where the numbers actually sit right now. Looking at the data, feeder steers in that 600 to 649 weight range came in at $413.01 per hundredweight for the week, starting June 21st, and that's on heavy volume, almost 5,700 head. The 500 to 549 weight class is even stronger, sitting at $454.45 per hundredweight. When you look back over the past month, both weight classes have been climbing steadily. That 600 weight class was at $410.98 back in late May, so we're talking about a couple bucks of steady appreciation week over week.
That's a healthy climb, no doubt about it.
It really is, and here's what's interesting. The futures front month contract has jumped from $347.89 in late May up to $368.94 now. That's not a small move in 5 weeks. The article from the cattle site confirms this isn't just a regional blip either. They're reporting the feeder steer weighted average price hit $383.69 per hundredweight back in the second week of April, an all-time record, and then climbed even further to $388.06 by the first week of May. USDA actually raised their second quarter feeder steer price forecast to $377 for the year. That's a 17% increase from where they had it before.
17% in one revision? That's not a tweak, that's a whole new ball game.
It really is. And looking at our predictive models here, the 1-week forecast for that 600 weight steer sits at $404.07 per hundredweight, with some pullback expected over the following weeks down toward $395 by the 4-week mark. So there's some softening built into the forecast, but we're still talking historically elevated levels across the board.
Well, I'll tell you, when the futures and the cash price are both marching up together like that, that's usually the market telling you something real, not just noise.
That's a fair read. Let's move into our first deep dive because this next topic has been building for a while and it just hit a major milestone. We're talking about USMCA, and the news broke this week that the Trump administration has declined to extend the agreement, which starts a 10-year wind-down clock. This comes from 2 separate pieces, one dated July 3rd and another from July 1st. According to the reporting, farm groups are already sounding alarms because this deal has been critical to agricultural exports for 3 decades now. The administration's stated goal is to use this transition period to push for changes that would reshore more production domestically.
10 years sounds like a long time, but I've seen how fast these things can sneak up on you.
That's exactly the point. And what's notable is the asymmetry here. The reporting shows the U.S. and Mexico are actually pushing ahead on auto trade discussions in parallel, but Canada has been sidelined from those conversations entirely. So this isn't a clean break. It's a messy, multi-track process. And for cattle producers who rely on cross-border movement of feeder cattle and beef exports, that uncertainty itself becomes a market factor. Meanwhile, there's a second piece of this puzzle. A ranch group has come out publicly supporting new legislation that would establish tariff rate quotas for import-sensitive agricultural products. And that legislation specifically covers live cattle, beef, and lamb.
Now that reminds me of something. Back in '94, when NAFTA first kicked in, every rancher at the coffee shop was convinced Mexican cattle were about to flood the market and wreck our prices. My daddy about had a heart attack over it. We spent that whole spring arguing over whether to sell down the herd before the bottom fell out. Some fellas did sell early out of pure fear, and they regretted it later.
What happened once the dust settled, Jim?
Prices held up just fine that year, and that cross-border trade ended up being good for both feeder cattle movement and beef exports over the next decade. Took a few years for folks to trust the new setup, but it worked out. Big trade policy always spooks the market before anybody's got real numbers in hand. The smart money waited on the data instead of running scared.
That's a really important parallel, Jim, because right now we're in that exact same fear before data window. The wind down clock just started. Nothing's actually changed on the ground yet, but you can bet there's going to be a lot of speculation and anxiety in the meantime. My advice to producers watching this, don't make major herd decisions based on headlines alone. Watch for actual trade flow data as it develops over the coming months, and pay attention to how that tariff rate quota legislation moves through Congress, because that could reshape import competition well before the USMCA wind down even matters.
Words to live by. Panic is expensive and patience is free.
Well said. Let's shift into our second deep dive, because this one's about supply fundamentals, and it's honestly the story underneath every other story right now. The June cattle on feed report showed feedlot inventory up 2.1% year over year, and that's actually the second consecutive month of larger feedlot totals after 17 straight months of year over year decreases. May was up 1.8%, so we're seeing a clear directional shift.
17 months of decline and now 2 months of growth. That's worth paying attention to.
It absolutely is, but here's the nuance from the Beef Magazine piece, and I think this is the most important sentence in the whole report. A bigger feedlot total does not necessarily mean higher beef production. Why is that? Because total beef production is actually projected down 4.5% to 5% in 2026 compared to last year, according to the Cattle Range article. And it's expected to decrease again in 2027 to the lowest levels in recent history. So you've got more cattle sitting in feedlots right now, but the overall herd feeding into that pipeline is still historically thin.
That's about as useful as a screen door on a submarine. More cattle in the yard, but less beef coming out the other end.
That's actually a pretty good way to put it. And there's a human element to this too. There's a piece specifically about beef jerky producers getting squeezed, and it notes the U.S. cattle herd is now the tightest since the 1950s. Jerky makers are competing directly with hamburger grinders and export buyers for the same lean cuts, and roast prices are up 20% or more year over year, staying elevated into 2026. So this tight supply isn't just an abstract cattle number. It's rippling all the way through to specialty processors and retail meat cases.
You know, everybody always talks about steaks and ground beef, but nobody thinks about the poor jerky guy till his costs go through the roof.
Right, and there's ongoing debate in the industry about whether this stalled herd expansion is due to business decisions or weather patterns. RCLF's Eric Gropper commented on this recently, and the honest answer is probably both. Drought conditions in key cow-calf regions combined with producers being cautious about rebuilding. That's all for today. Remember to sign up for our free daily briefing at herdadvisor.com. And if you want complete cattle records without the hassle, try the Cattle Record Guide free for 14 days. Enter records from the field with your gloves on. Just say, "Hey Siri."
Catch you in a couple days.
All right, see you then.